Good morning, everybody. Thank you for joining us. My name is Stacy Mitchell. I am Director of Communications and Outreach with Viridiant. So I'm kind of more so here in the background to make this a great experience for everybody, make sure that we get all of your questions answered. We are joined today by Rob McCraney, Viridiant's Business Relations Manager, and Trevor Tolbert, the Senior Vice President for PNC Real Estate. So thank you, Trevor, for being our guest speaker today so that we can have a really great conversation around green financing. We've got really great turnout today for the webinar. So thanks again, everyone, for joining us. As folks are still joining the meeting room, I just want to go over a couple of really quick housekeeping things before we get rolling here. Since there are several people on today's webinar, we do ask that if you have a question, feel free to drop those into the chat function or into the questions function there in the side panel of GoToWebinar. We are planning to leave a couple of minutes at the end of the webinar for question and answer. So I will be fielding those questions to Rob and Trevor at the end of the webinar. So once again, thank you for joining us. And with that, I'm going to go ahead and turn it over to Rob.
Thank you, Stacy. My name is Rob McCraney, and welcome. Like Stacy said, today I'm going to take you through two different kind of modules. One a little bit about Viridiant, the other one will be about a new financing program called the HIEE program, and then I'll hand it off to Trevor for the bulk of the presentation to get into what PNC has to offer. So without further ado, if you're not familiar with Viridiant, Viridiant is a nonprofit organization. We've been around since 2006, and we support any and all kinds of sustainable green building construction for the built environment. That includes our flagship product, the EarthCraft certification, as well as NGBS and several others. We have worked on over, gosh, probably close to 330 different projects and I think about 31,000 homes. So that's a little bit about us. We're located in Richmond, Virginia with a staff of, I think, 15 or 16 and are growing every day. So who is Viridiant for? Viridiant covers single family homes, multifamily homes. We can do top floor multifamily, bottom floor commercial. We can do light commercial. So we cover all types of homes. Our light commercial program is essentially about 80,000 square feet or less. If it gets into boilers and chillers, we don't really deal a lot with those type of projects, but anything that's got conventional HVAC, and if it's over 80,000 square feet, we can look at it and do that. We are primarily focused in the mid-Atlantic, so Virginia, Maryland, and DC is what we cover. All right, the next slide talks a little bit about our services. Viridiant does provide green building certifications for EarthCraft, Energy Star, excuse me, Zero Energy Ready, Lead for Homes, Passive House, and NGBS. All of our project managers and I believe all of our technical advisors are ResNet HERS rated individuals and are assigned to each project as well, which is really nice. Some of the things that we get into are HVAC design audits. We do energy efficient mortgages. We've also stepped into a little bit of solar. Some other things we do as a nonprofit, we provide builder training, excuse me, builder professional training. We provide our builder science lecture series. We helped out on the 2015 Energy Code training, and we provide annual conferences for our projects that we have and showcase the ones that have done really well. And we can get into HVAC design. We do load calculations on all of our projects, and we also do level 1 audit and utility allowances. So that's a little bit about our services. We're here to provide services for all of the LIHTC green building programs, both 4% and 9%. So when we look at a project, we look at the structure of the system, and that is to include the building envelope. We focus primarily on the energy efficiency. We look at the continuous air barrier. Is there complete insulation coverage? We are very concerned and focused on the indoor environmental quality of air, whether there's controlled ventilation, proper moisture management, reducing any kind of organic growth, things like that, and also making sure that the HVAC systems are properly sized and appropriate for the size of the building space. So benefits with EarthCraft is that we do energy modeling on every single project. The EarthCraft certification is our flagship product. Like I said, we do others, but we prefer this one because it's primarily focused on the Mid-Atlantic. All of our projects have site visits. Every project has an assigned technical manager, excuse me, a technical advisor, and a project manager. And like I mentioned before, we are resident certified advisors, and we give you guidance throughout the entire timeline. The bottom bullet point talks about the next several slides, and something that is, I think, very important. This is a new program that we have gotten involved in. So if you're going to apply for the HIEE program, you have to have a green building certification, the manual J certificate calculation, as well as the fresh air ventilation. We provide, the dehumidification, duct leakage testing, air sealings, radars, and all that. So all of that is something that Viridiant will provide for you in order to meet the HIEE program. The next slide talks about the HIEE program. And what is that? That was Housing Innovations and Energy Efficiency. It was started this year in 2021 and hopes to go through the next several years by the DHCD. The first round was back in April. The second round coming up that you need to be aware of will be happening in fall, around October sometime. And the overall objective of this is to reduce energy bills and improve comfort for low-income housing tax properties. This slide is pretty important. It tells you exactly what the benefits are. Essentially, if you look over in the far right-hand corner, the column, the benefits are all the same. It's $7,000 per unit, or 5% of the total construction cost, whichever is greater, up to $1.5 million. And so in order to meet that, you can either do new construction, sustainable rehab, or adaptive reuse. And then the requirements for Virginia housing would be an Energy Star version 3.0, or meeting a HERS 30 or 80% improvement if it's a rehab. And it's adaptive reuse, you need to meet a HERS index of 95 or below. The HIEE requirements for these programs in order to receive the $7,000 per unit is going to bump you up from an Energy Star certification to a Zero Energy Ready Homes. If it's new construction, you'll need to be a little bit better improvement on the HERS. You'll need to be a 40% improvement or 70 or better. And then for adaptive reuse, it's got to be an 80% or better. And that's across all units too. So we kind of made this program a little bit short because I want to get into what Trevor has to say. So if you want any more information about the HIEE program, certainly reach out to myself. Again, this last slide just covers the requirements down at the bottom. You do have to have a green building certification, as well as everything else that is listed here. So that is a little bit about me. I'm going to pass it over to Trevor, and I'll tell you a little bit about him. Trevor is the Senior VP for Agency Lending at PNC Bank. He's based out of Washington, D.C., and has over 20 years of lending in both the HUD MAP and LIHTC projects. He is HUD MAP licensed and lien licensed, and focuses primarily on 4% and 9% deals. And so, Trevor, I'll pass it over to you.
Hey, thanks, Rob. I appreciate the introduction there. Again, as Rob said, my name is Trevor Tolbert. I'm up in the DC area here at PNC. I've been with PNC about 1.5 years now. Been in the marketplace for nearly 20 years. I'm not going to date myself just yet, but a little bit about PNC. If you guys, I'm assuming most people on the call are local. PNC is the branch, location down the street where you can do your deposit and checking. We are a full service bank, ever growing. I think we're now the 5th largest in the country. We recently purchased BBVA Compass, which is based out of the Texas region, so it has the southwestern states there. That's just, our footprint's ever growing. I focus nationwide, probably have about 15 deals in DC, Baltimore area that I'm working on now, but then also have deals in LA, Miami, Oregon. Just recently closed a deal in Fargo, North Dakota. So we are all over the place. And myself, I am, again, national. I'm client-based. So once I find a client, I follow the client. We do have a counterpart on our tax credit side, our TCS, or Tax Credit Solutions Group. That group, focuses on providing equity for LIHTC deals, both 9 and 4. We provide everything from bond financing, construction lending, bridge financing, agency financing, so perm debt, what else? Pretty much, you name it, we do it. I'm working on one transaction, for example, where we have 5 different sides of the transaction itself up in northern New Jersey. During this presentation, I'm going to go through a few things. You know, unlike Rob, I'm probably not going to get as detailed. I'm sure we can save that for a few questions at the end. You know, again, I am on the origination side. We look at things from a 10,000 foot level. So I'm going to give a broad overview on things. One, I think a rate update would be interesting for everybody. You know, we all know that rates are low. I can go through kind of where we're seeing them now, deal dependent, of course, and then give agency update where Fannie, Freddie, and HUD are focusing right now, their timelines, what they're up to, what they're looking for, their goals, you know, what gets deals done these days. And then I can go into the banking balance sheet. So that would be PNCs or other balance sheets that I'm seeing in the market. You know, how active they are, again, what they're looking for, what product types they will do, what product types they won't do. Then I'll highlight the green financing that we are seeing. There's some interesting updates specifically with HUD. HUD released a new map guide in March of 2021. There were some pretty major changes on how you qualify for green there. Then go through the affordable versus market rate transactions that we're seeing. My business personally is probably about 70% affordable, 30% market rate. So I can give some insight on I guess, what qualifies for affordable, who's doing market rate, who wants to do market rate, and then just an overall market outlook. Highlight kind of what we're seeing. Very interesting times. You know, we're all on a Zoom call rather than at a conference right now. I did go to my first conference last week, which was the Texas Housing Conference, Affordable Housing Conference. There's 1,200 in-person registries. So, you know, people are out and about. PNC themselves, you know, we originally were targeting to go back to offices September. There was a lot of backlash. And they've edited that to maybe November or maybe never. So I think you're going to see the face of, you know, office life continue to change and continue to evolve depending on the company. Rob, if you want to go on to the next slide. Thank you very much. As everyone knows, rates are low. They are really, really low. Great time to finance, great time to rate lock, great time to get anything done that you can. You have something, you know, we have kind of a rule of thumb. If you can save about 100 basis points, it's worth refining, or if you need to, obviously, you have a balloon payment or a cash out opportunity, take advantage. It really does make sense to move forward on these things. Not just saying that because I want to make money or do your business. You know, Fannie Mae, they are low. There's a big difference between each one of the products, so it's very product dependent. As you can see, you know, we do business under 6 million, over 6 million. I have one deal that's 117 million. I have one deal that I just quoted today that was 2.1 million. So there's a wide range there. The pricing, they're really looking for the larger product. I think they think there's a lot of economies of scale there. Typically, it's a stronger borrower, sponsor, better net worth, liquidity. So they give quite a discount. You know, as you can see here, about 70 basis points on a refi or acquisition. If you're simply just a larger loan, they will do smaller ones. They really like to use their SBL program, which is a small balanced loan program. Fannie and Freddie both push for that. Fannie, if it's over 6 million, you can't go SBL. Freddie, if it's over 7.5 million, you can't go SBL. There's some advantages to the SBL program. The cost about $12.5 for all legal, third parties, processing, where on the Fannie or Freddie conventional, you're looking upwards 25 million. I'm sorry, 25,000 probably. So it's a good difference, and the processing times are a lot faster for the SBL, honestly, but they are more rigid. You are getting a product that doesn't have any flexibility. There's no waivers. There's no changing the docs, you know, legal docs, closing docs, all that kind of stays the same because you're fitting a, you know, a square peg in a square hole. It can't really be no flexibility there. Freddie Mac, kind of the same thing. The rates are very low. They, you know, conventionally look for 7.5 million or higher. Oh, I guess I should have highlighted forwards. Fannie Mae, their forward program is very, very active right now, where Freddie Mac, their TEL program, is pulling back. As you can see, there's quite a difference in rates there. One of the main things with this difference to highlight is Fannie Mae has what they would call a negative arbitrage. They fund it fully, so you're paying interest on that. What you have to do is then reinvest it, and this is very detailed, so if anyone does have specific questions, give me a call after this. But it costs more money typically to borrow the Fannie Mae loan, but the rate is considerably lower. So it's a deal by deal situation. Freddie, they have lower fees, lower, but higher rates. So it really depends on the deal. The bigger the deal, typically Fannie Mae works best. And then HUD. HUD rates are, I didn't think they could get any lower. I'm sorry about that. They did. They are around 215 for a 223F, which is the refi acquisition program, and then as low as 250 for a sub rehab D4, which is their new construction program. Quite a considerable difference to where they were even 5-6 months ago. There's a lot of demand for this product, so it's they're very active out there. Please remember that those rates, MIP, which is the mortgage insurance premium, is in addition to that, and that ranges from 25 to 65 basis points. Everybody, you guys, me, agencies, busy. They're super, super, super busy. HUD timing is the worst, and it's always been the worst, but it hasn't gotten any better. HUD says they're hitting their processing time. They're not. What they do is now, instead of accepting your deal into processing, they wait. Right now, for example, not to discourage anyone from going HUD, but the Baltimore office will not, if I put a package in today, they would not accept it into processing till November, is what they're saying. They are trying to relieve this stress upon their underwriters and production team by hiring some contract employees. I think that should go out soon, but who knows? The federal government doesn't move quickly on anything. But it is very deal or office dependent, right? Minneapolis they have no queue. Baltimore has a 4-month queue. So really depending on where your deal is, the timing is dependent upon that. They also will give you some advantages for being an affordable deal. They kind of let you cut the line a little bit. And then on D4, it always took 12 to 14 months. Realistically, you can maybe push them through if there's an affordable component or a LIHTC component, 10 months. But you're seeing that it takes 12 to 14 months to get one closed. Typically, I tell my clients on that specific project or product, because it's construction, to bring us in early. We'll help you structure the deal. Drawings take forever. Zoning takes forever. So the earlier we can get involved, the better, and it kind of lessens your lead time. Fannie Mae, they used to be 45 to 60 days consistently. I met with our rep last week in Texas, and they're seeing 90 to 120 day timelines to be realistic, from application. And it's just because they're backed up. They're setting records this year, as is Fannie, as is HUD. So everyone's busy. Freddie's a little bit better, depending on the complexity of the deal. You're typically seeing 75 to 90 days to get to closing after application. Rob, we'll go next one. Cool. Balance sheet. We're a bank. I don't want to bash us at all, but we're pretty conservative. Really, we're super selective on deals. It really is relationship based. If you've done deals with us before, we'll get it done. If you do your banking with us, not your personal checking, but your business banking, that may help as well. Deal size, we're looking for bigger deals. They don't want to do anything under 10 million really. And this includes our bridge product. And it really depends upon profitability too. The deal I mentioned earlier where we're doing 5 different pieces of it, we are actually doing an $86 million construction loan there out of our real estate banking group. I was surprised, in all honesty, but they were able to come to bat for the deal. They like the sponsor, they like the transaction, and they like that PNC's on all 5 pieces of it. So there's revenue for the bank in each of those pieces. I typically see my product pair up well with our debt products, our equity product on the LIHTC side, but there's no requirement that we do both, but it does help sometimes with the pricing. And then, like I mentioned, relationship. If we've done a deal with you before, we're much more likely to do a deal with you again. We like the first deal to be easy. Who doesn't? But, there are other shops, I won't name any names, that are a little bit more flexible on their bridge product or their acquisition product, especially when it comes to timing of, say, a HUD deal. We're very willing to do a bridge loan for a deal where we know there's going to be a takeout, right? Like whether it's a bridge to resyndication, a bridge to just taking it down HUD in a year. If there's a story, we're interested in doing it, but we really do want that net worth and liquidity to be pretty strong on the deals. And then product type, we're not interested in commercial retail. Students coming back a little bit, but we're not overly interested in that, nor are the agencies. They took a big hit on the student housing with COVID. And then we are doing some healthcare business, but it's really sponsor based. So if we have a relationship with you, that helps a lot. These are all businesses that were pretty crushed by COVID, and that's why we don't see them back just yet. Next one, Rob. Thanks. We can talk about the green rewards now. Fannie and Freddie are both, depending on the product and the type of deal that you're doing, offering discounts. They vary. They do have a push for green rewards here. They do want to do green projects. They do want energy efficiency. That all kind of checks boxes and makes them more interested in the transaction. It does help pricing, and it does help get it through. There are some other things like affordability that they're maybe a little bit more of a push on, but they do, they love when they're in conjunction with each other. And then HUD changed their map guide, which is kind of their underwriting Bible, in March 21. I believe it was March 16th-ish. There were some big changes to the green MIP specifically. So previous to the March 21 change, you would qualify for a green MIP, which is actually discounted to 25 basis points rather than 60 or 65. If you pass an Energy Star test and were scored over 90. And that was for any deal. It could be 20 years old. If you were running energy efficient, that worked and they were happy. They saw a lot of people taking advantage of this. They felt that it was being too taken advantage to, or maybe the regulations were a little too easy. So what they did is they've changed this program now. If the project is 3 years or older, you now need to go through, and I'll let Rob highlight this maybe later, the NGBS process, which is much more stringent, much more expensive. Just went through it on a deal or considered going through it on a deal. It didn't make sense for the borrower, and there was no guarantee that they would actually even get approved for this MIP after spending, I think it was roughly $150,000. So we passed on it and they went with the regular MIP. Within that 3-year window, Energy Star, which is a relatively affordable, easy test, easy score, and we've had very little process or problems. We've had a lot of success getting that approved and getting that lower MIP. The lower MIP can be a giant savings depending on how big the deal is. 40 basis points over 35 years is a lot of money. So, it's a case-by-case thing whether it's worth it or not. Rob, next. And then affordable versus market rate. I'm not sure how in touch with the markets everyone is. Affordable is a giant push. I had a deal recently that was going to be a D4 up in the DC area. HUD passed because it was market rate. We came back at 100%, 60% AMI. HUD accepted it. So it's really just something that they are focused on. In the DC market here as well, I'm doing a few refis that are within the 3 years of C of O. And they're still kind of in lease up, so they've limited history. And HUD's not sure they like the market rate market. So meaning that they're not confident that there's enough demand for the supply that's coming on. And that's, again, market by market. But it makes it a lot tougher. So affordable deals are just easier with HUD. The construction program, basically, as I mentioned, is not interested in just producing just market. In order to qualify for affordable for HUD, you either have 20% of the units at 50% AMI or 40% at 60% AMI. The more affordable, the more demand for the HUD or from HUD for your product. Freddie Mac, they definitely want to do these for refinance acquisition. They're not so excited about their forward. What it is Freddie doesn't book this business against their annual pot of money until it converts. The forward is like an early rate lock before to guarantee you a rate after the construction process is done and you're stabilized for 90% occupancy for 90 days. They put a lot of money out the last couple of years. So they're very worried that in 2-3 years when these deals start stabilizing, they're just going to have no more money for new deals. So they've really started limiting the projects that they're doing. They still do them, the right borrower, the right deal, they have no problem. But as you can see, they're not doing us any favors on rates. Fannie Mae, huge demand for market rate right now. They don't have enough. They're getting so much affordable business in there that falls into that pot that their market rate without student housing or senior housing, market rate senior housing, it's not getting full. There's a lot of money for that, and they really really want to push that. As I mentioned, the affordable buckets are getting pretty full. Not that they won't take a deal, and it does help them, but they're not as incentivized when there's so much supply. Obviously the demand from them goes down. They are very active on the forward product though. So we're seeing a lot more MTEVs or Fannie taxable deals. And that's just because they're not as concerned as Freddie is. I guess they didn't see the business there. Freddie was doing a lot more forward business than Fannie over the last 2 years, let's say. So their bucket, again, 2 years out is pretty full, where Fannie is not. Next one. And then, overall, business is booming. We are setting records. Every single agency I listed here doing record business. Our tax credit group doing record business. Our balance sheet group probably not doing record business, but they still are active. Banks are tight. I run across it with whether it's us, Wells, Key. Their balance sheet lending for some reason, even though they have an abundance of money, is not putting it out there. I think they're concerned with risk, and banks historically are risk adverse. As I mentioned, all the agencies, record production again. They did last year, they're going to do this year, they're going to probably do the year after. So they're hungry for deals, but they're full too. So they're moving slowly. They understand that people need to get deals done, but it is what it is. And what we do is just ask clients to bear with us. We push as hard as we can. We're extremely busy. We're having a tough time keeping up with demand, and I can't imagine that the agencies can even do better. They are always underserved. So we are seeing, I'm doing a lot of construction business, prices for materials and labor coming down, as everyone probably follows. Everything, wood, lumber, copper went crazy last year. This year, I think lumber is actually down on the year. So we're seeing prices come in. Deals are working again. And there's some opportunity there with lower prices, but still very low rates to get deals done that maybe didn't work a year ago. So revisit your deals, your portfolio, and see if something would work now that didn't then. And then, as I mentioned, we are back in person, as far as meetings, conferences. I think my next conference is the Georgia conference in September. Then we have another one in Chicago in November that's well attended, and I think they expect people to be there. The one I was at last week, it was packed. I mean, really packed. Couldn't get reservations at restaurants even because it's so packed. So the world is definitely coming back, but I think it'll be different. Again, as I mentioned, PNC is never going back to the office. Many of my clients say, they're going to go to the office 2 days a week. But I think everyone saw how successful that this kind of interface can be, that there's not really much concern that this will be okay. The markets will be okay and people will be okay. So our view here is, business as usual. And that's about it. I'm sure there's some questions, or I can get more specific on anything. Please let us know, whether it's offline or on, how I could ever assist. Thank you.
Thanks, Trevor. That was great. One of the nice things about being on Zoom here is the accessibility we have to be able to have this conversation with you and bring everyone together to talk more about this topic. So we definitely want to open it up to questions, whether they be 10,000 foot or specific, while we've got these two wealths of knowledge here in front of us. So feel free to drop any questions into that questions function or the chat function there. And Rob and Trevor would be happy to answer those for you.
Trevor, I had a question. While
Sure.
Somebody's thinking about something. So can you elaborate on the project you were talking about with NGBS that was not able to get
Sure.
the MIP, and was there any reasoning as to why another green building program was better than that one?
So we actually did not go with any green building program there. What it was is this project was built in 2009, so it's roughly 12 years old. Class A building up here in Rockville, Maryland. We were engaged for Energy Star. We did not get our application in time. So HUD said they would not recognize the Energy Star testing, and that we had to go through this NGBS program. Yeah, so it was not, had an unhappy borrower, had an unhappy lender. So we actually, we failed the Energy Star test, to be honest. So there's going to have to be some edits. So the reason that was going to be so costly was because they were going to have to come in and do all their testing, and then they do recommendations on repairs. And they're typically seeing these repairs, their appliances or their HVAC units,
Right.
between 1,000 and 1,500 a unit. It was a 199 unit building. So the cost of doing the testing alone, at least the quotes we got, were in the $30,000 range, because they have to come inspect the units, they have to test. It was very expensive. It was definitely during the height of COVID. It was March, and the borrower, residents didn't want people. It was just kind of a cluster of just a bunch of things coming together, and the deal just didn't make sense to do it. And we were told it's going to be 1,500 a unit. There's 100,000, there's 150,000 plus the 30,000 to test, and there's no guarantee that they even pass. So the borrower was like, I don't want to throw $200,000 at a chance, even if the MIP savings would be well worth it over the 35 years.
Right. I think we've gotten to a point now where we can do testing. It's a lot easier than it was, a year ago, because it was a nightmare.
Yeah, you can get into units, right?
Right. You can't even get into them. So yeah. Thanks.
Yeah, that was that example. Sure.
All right, we've got a question for Rob. Can you speak to the additional project cost to achieve Zero Energy Ready versus other green programs?
Sure. So when you go Zero Energy Ready, you're going to start out with one of Energy Star if it's a LIHTC project, and then they step up. So the Zero Energy Ready is not that much of a leap. If you're talking about going to a passive home, it gets to be significantly more, but Zero Energy Ready just means that you're ready. Usually you have to put some type of conduit into the building for potential solar that you may put on the building down the road, things like that. So the leap is not significant. The best thing for you to do would be to register your project with us, have us take a look at it, and we can kind of give you a breakout on what would be required to meet Zero Energy Ready, as well as what the cost would be for our services, and then you can bid that out to the contractor and see what the actual costs are from the construction side.
Thanks, Rob. Question for Trevor. Does HUD, Fannie, or Freddie provide for interest-only periods on their permanent forward loans?
On the permanent forward, they can. It's deal by deal, but only Fannie and Freddie. The HUD loan is a construction and permanent one, so they don't actually, they do provide a forward, but they provide the construction loan as well, where Fannie and Freddie just provide the perm. But yes, there is an opportunity for interest only on both of those, both agencies.
Great, thanks, Trevor. Any other questions from anyone? We'll be sharing contact information following the webinar as well. So if you wake up in the middle of the night with that question you wish you would ask while we were all here, fear not, you will be able to reach out to all of us on the webinar today to get all of your questions answered. Nothing?
Right.
All right. Well, with that, Rob, Trevor, thank you both so much for taking the time to go through this information with us. It was great content, and like I said, it's really nice being able to be at the table together in this virtual setting for these conversations that might not otherwise have been able to take place. So
thank you very much.
Yeah, thanks,
Thanks,
Trevor.
everybody.
Thanks everyone for
Thanks,
joining
Trevor.
us.
Bye all.
Yep.
Thanks, Stacey.